I gave AI complete control of my crypto intelligence for 30 days. Every morning, it analyzed thousands of data points across crypto markets, global equities, on-chain signals, and macro indicators. Then it told me exactly what to do. Here's what happened. Before I show you the results, let me explain what I actually built. This is not a trading bot. I did not hand my wallet keys to an algorithm. Instead, I built an AI-powered intelligence pipeline. Every single day, it generates 2 full reports: a daily crypto intelligence report and a daily global equities report. The system pulls data from exchange APIs, on-chain analytics, macro indicators, and news feeds. Then it runs that through large language models, specifically Claude and GPT, to generate structured analysis. Each report includes a market signal, either bullish, bearish, or neutral, key price movements, top movers, risk indicators, and a summary of the 10 most important headlines. Think of it like having a Bloomberg terminal and a research analyst that works 24/7, but powered by AI. The question I wanted to answer was simple. If I followed these AI-generated signals for 30 days, would I beat a basic buy and hold strategy? My portfolio at the start: SOL and ETH, an Ethereum ETF on CBOE Australia. Week 1 was impressive. The AI immediately flagged a bullish signal on SOL based on rising on-chain activity and increasing developer commits. I would have missed this. I was focused on Bitcoin headlines, but the AI was tracking hundreds of data points simultaneously. The signal was right. SOL moved up over 7% that week. My portfolio was up 4.2% after just 7 days. The daily reports also flagged a macro risk: rising U.S. Treasury yields, that would eventually matter in week 3. At this point, I was thinking, this is too easy. The AI catches things I would never see in time. AI drives 89% of global trading volume today. The crypto AI market is projected to grow from $5.1 billion in 2025 to $55.2 billion by 2035. The tools are real, and they are getting better fast. Then reality hit. In week 2, the market got choppy. Bitcoin dropped 4% in a single day, and my AI system flagged a bearish signal. I followed it and shifted to a more defensive position. The problem? Bitcoin bounced back within 48 hours. The AI was wrong on the short-term direction. This is where the data gets interesting. Top AI platforms achieve 55 to 65% directional accuracy. That sounds low, but professional human traders average around 52 to 55%. The edge is small but consistent over time. Week 3 brought conflicting signals. The crypto report said bearish on Bitcoin, but the equities report flagged a risk on macro environment. Which signal do you follow when your own AI system disagrees with itself? This is where the human element matters. I looked at the broader context, the regulatory environment, upcoming ETF flows, and I chose to stay the course rather than sell. That decision, ignoring one AI signal while following another, ended up being the right call. By the end of week 3, my portfolio was up 6%, despite the AI getting the Bitcoin direction wrong twice. After 30 days, the numbers were in. My AI-guided portfolio returned 8.7%. A simple buy and hold strategy over the same period returned 5.1%. That is a 3.6% edge. Now let me put that in context. AI-driven rebalancing has been shown to deliver 83% higher yields versus static positions in academic studies. And in a Reddit experiment running since 2024, Claude managed portfolios that beat the market by 27.74% after 473 days. The key finding was not that the AI was always right. It was not. It got the short-term Bitcoin call wrong. It generated conflicting signals across reports. But it was right more often than it was wrong, and it caught signals I would have completely missed. The SOL breakout in week 1 alone justified the entire experiment. Here is the honest breakdown. AI is better at 3 things. First, 24/7 monitoring. It never sleeps, never gets distracted, never misses a data point. Second, pattern recognition across hundreds of variables simultaneously. No human can track on-chain activity, macro indicators, exchange flows, and news sentiment at the same time. Third, removing emotion. The AI does not panic sell. It does not FLMO buy. It just follows the data. Humans are better at 3 things. First, strategic context. Understanding that a regulatory announcement changes the entire risk profile of a position. Second, risk appetite. Knowing when to size up or size down based on your personal financial situation, not just the data. Third, knowing when to ignore the signal. Sometimes the AI is wrong, and experienced investors can feel it. The real winner is the hybrid approach. AI generates intelligence, humans make decisions. This is not about replacing human judgment. It is about augmenting it with better data, faster analysis, and consistent monitoring. If you found this useful, subscribe. I cover crypto markets, AI infrastructure, and portfolio strategy every week. The daily crypto and equities intelligence reports I used in this experiment are available on Gumroad. Link in the description. Premium research is on Gumroad at unchained.gumroad.com. In video 11, I built the 3-layer crypto portfolio model that this experiment was based on. Watch that next if you want the full portfolio framework. Drop a comment. Would you trust AI with your portfolio intelligence? This is educational content only. It is not financial advice. I hold positions in SOL and ETH as disclosed. AI-assisted visuals and narration used in this video. Thanks for watching. I will see you in the next one.